we use PPP. The concept is the same. Wherever inflation is highest, that country's currency will go down. But how much? We can calculate through PPP. So international trade is the mechanism by which the inflation differential affects the exchange rates according to this theory. So we'll talk about the summary of purchasing power parity, and let's take a coffee break, then we will start from here. Okay, class, welcome back after a short break. So here, this exhibit 8.1 tells us about the summary of purchasing power. So when you have relatively high local inflation, it means your local currency or your home currency will depreciate. When it depreciates, imports will be higher, exports will be decreased. So local currency sounds depreciate by some degree as inflational differential. What if you have a low relative inflation as compared to local? So relatively low local inflation, which means the foreign currency is over there is highest inflation, so it will depreciate. So it means your home currency will appreciate. When home currency will appreciate, imports decrease, exports increase because we can afford foreign goods. So local currency should appreciate because of this inflation differential. If it stays the same, then there is no effect, right? Okay, now, Nicola, your question that was, you asked a couple of slides ago, I gave you the partial answer. So why purchasing power parity and also the interest rate parity doesn't hold or does not occur? Because we know that exchange rate not only just depends on interest and inflation, it also depends on income, government controls, and expectations, right? So we just talk about purchasing power parity and interest rate parity. In purchasing power parity, we just talk about that the exchange rate of foreign currency will appreciate or depreciate based on just inflation, which is just one factor. And in interest rate parity, we talk about that interest home minus interest in foreign, which is the forward premium. In this, we just talk about, sorry, let me just correct it. Interest, we talk about in interest rate parity, and inflation, we talk about in inflation. So where are these other factors? We didn't count that. So co-founding effect is a change in a country's spot rate is driven by more than inflation differential between two countries. For example, in our last, the Mexican inflation was 4%, US inflation was 3%. So Mexican appreciated by 4%, right? So why this is not close to 4%? Because of other factors. So we call this is not equal to purchasing power parity, appreciation or depreciation. It's because of co-founding effect, which means not only inflation is disturbed, but government also took some measures to cope this inflation as well. If inflation is higher, definitely government, try to decrease this inflation into some its normal range. On the other hand, we are talking about purchasing power parity, and also there is the parallel effect of government control as well. So in that case, the purchasing power parity doesn't hold, right? So example include, assume that Switzerland's inflation is 3% above the US inflation. So technically, if the purchasing power parity holds, it means that the Swiss franc should depreciate by about 3%. Yet, if the government of the Switzerland imposes trade barriers against some US exports, Switzerland's consumer and firm will not be able to adjust its spending in reaction to the inflation differential. So therefore, the exchange rate will not adjust as suggested by the purchasing power parity that it should depreciate by 3%. Right? So that's why after every parity, we talk about everything remains constant. Right? If that is not constant, then purchasing power parity, also the interest rate parity, they doesn't hold. They don't hold. Okay. Number second is no substitute for traded goods. What if we are importing and if we are importing raw material and we cannot import it from any other country? Then we don't have any other option. Even then, we will be purchasing from that country. For example, if substitutes goods are not available domestically, consumer may not stop buying imported goods. So it means when they are not buying imported, not stopping to buy imported goods. So in theory, the exchange rate should increase and your import should decrease, but it's the opposite one. Why? Because you are buying raw material or the high tech, you know, goods. For example, you're buying plant which cost you millions and billions of dollars, and you cannot avoid that. So you see in the market, exchange rate is not adjusted according to purchasing power parity. So let's talk about this example here. So reconsider the previous example. If the US consumer do not find suitable substitute goods at home, they may continue to buy the high price goods from Switzerland. So the Swiss franc may not depreciate as expected according to PPP. In fact, it may appreciate. So that's now happening to yuan, Nicola. Now you get the idea why, even though the theory suggests that the yuan should depreciate, but even then yuan is appreciating. Why? Because people are importing raw material or the goods from the China, and they cannot find it, they cannot find a suitable option in their home country as well. Understand? So Nicola, your query is well answered.
Yes, pretty much.
Okay. If you have any question regarding the interest rate parity and purchasing power parity, you can ask. If not, then we'll talk the third one, which is international Fisher effect. No? Okay, let's talk about this theory. So interest rate parity, it talk about regarding interest, and it says that wherever is the higher interest rate, the premium increases and the foreign currency appreciate. Right? If interest in foreign currency is higher, foreign currency will appreciate. The purchasing power parity says that if relative inflation is higher, right, then what happened? If relative inflation is higher in foreign currency will depreciate. But the international Fisher effect, it provides counter argument. And it says that wherever there is higher interest rate, its currency should depreciate. So remember, these two theories, we talk about high inflation means wherever the highest inflation, its currency will go down. We talk about that wherever the highest interest, its currency will appreciate. But the international Fisher effect, it says that wherever the interest rate is higher, its currency should depreciate. Let's talk about this. We already talked about this concept in chapter 4. in which we talk about that a high interest rate can act as strong demand for local currency. The international Fisher effect, or IFE, we call that. How interest rate affect exchange rate? It uses the purchasing power parity to support its argument. It means we are deriving wherever the interest rate is higher, its currency should depreciate with the purchasing power parity argument. It means the PPP is supporting the IFE. Let's talk about this. So according to international Fisher effect, the interest rate is it says that the interest rate, which is nominal, is equal to risk-free rate and inflation. So why the interest rate is higher? Only one thing, because of higher inflation, because risk-free rate is approximately same all over the world, right? For example, in your home country, if the interest rate is 12, if you see its breakdown, it will be always be based on LIBOR plus any risk. So LIBOR is London Interbank Offer Rate plus your country's risk. For example, let me just give you the example on a whiteboard. So nominal interest rate is, let me just write it down here. Risk-free rate plus inflation. So in component of inflation here is, it's not about like 10% inflation, you just put 10% here. It is the component of inflation. For example, if the risk-free rate, normally risk-free rate is LIBOR, London Interbank Offer Rate. So it's published on daily basis as well, on 3 months, in a quarterly basis, on semi-annually basis, on yearly basis as well. You can go to the London Interbank Offer Rate, you can just find out that. So for example, in Serbia, if the interest rate is 10% and LIBOR is 3%, then it means risk-free rate would be 3%. 3% plus this 7% is coming from some kind of other risk, which may include country risk factor, which may include, according to some other, like maturity risk premium, inflation premium. So there are components of interest rate. This is the finance theory. In financial management, we'll talk about this interest. So it says that risk-free rate plus some kind of other risk, which is country risk, inflation risk, or exchange rate risks, also covered in countries risk, maturity risk, default risk, and there are many others. So if Serbia, Greece, also risk-free rate, for example, Greece is 13%, the risk-free rate is 3%, and 10% is the other risk factors. So risk-free rate are same. It means then the other factor that